and we'll get started. So just so you know, Margaret, I'm going to I have a series of slides that I like to go through. That's a fairly recent. You'll see I started working with another financial firm called Factum Financial, and I really like their presentation. So that's what I'm going to be going through, and I'll pop out some questions. Feel free to answer them if you'd like, if they're relevant. That's also for the benefit of those who listen to the recording. So, okay, I'm just going to share my screen and start the slide presentation. Okay. Come on. Okay. So, welcome. Want to welcome you to the Creating a Rock Solid Foundation with the Perfect Asset. And as I was just mentioning to my attendee here, uh, this is going to be a slideshow. I'll be posing some questions, and this is a slide presentation that was put together by my partners at Factum Financial. And you see the tagline, Factum Beat the Banks, because that's what we're aiming for, is to sort of take on that function that the banks have all for themselves now and for our own benefit. So let's go ahead and get going here. So the first thing that I like to do is just to ask a question. So if you're watching on a recording or for your benefit, Margaret, when you think about wealth, making money, keeping money, all that kind of good stuff, what do you see as the single biggest problem that we have in this country when it comes to financial abundance or the ability to experience being wealthy? So I'd like you to give a little bit of thought to that, and then I'll jump into what it is that I see, and we at Factum what we see as the biggest issue, and how there is something that we can do about it. So once you've sort of thought about that, Margaret, feel free to pop in the chat if you'd like. So one of the reasons I really like working with these folks from Factum is the focus on these 5 areas of life. And it's, even though we're talking about money and wealth and that kind of thing, it's really just a piece of the puzzle. And so we really like to focus on these 5 different areas of life, and how if you can have abundance in these 5 different areas of life, you have a pretty good life. I mean, more than a pretty good life, you have a great life. And so we believe that they're all tied together, and it's important to sort of nurture all of them. You have the spiritual part on top there. If you believe in God or the universe or whatever it happens to be, your how you view that, the spiritual side of things. And then, of course, on the personal side, how are you with yourself? How's your health? The things that you like to do, your hobbies, is that being nurtured? Are you taking care of your personal side of things? And then, of course, on the occupation side, what are you doing for work? Is it something that lights you up? Is it something that you feel makes a difference on this planet, in your community, whatever the case might be? And of course, your family, and how family is, however you define that. It can be, if you have wife and kids, or husband and kids, or certainly we all have parents and grandparents, and whatever you define as family, is that being nurtured? Is that being taken care of? And then, of course, the financial side of things, which, of course, is a focus, where I come from as a financial professional. And we all know that how your finances are going often greatly impacts these other 4 areas greatly. It tends to be, one of the biggest drivers on how our lives are doing. Money is a real stressor, or lack thereof. So this is really what we like to focus on, as that's sort of the approach we're taking. It's a very sort of holistic look at our lives, and then ultimately how money and wealth taps into that. So if you think about of money and especially in the form of savings and liquidity and having money available to you. Here's a question. Is it possible? Because most people think of savings, that it's in a savings account somewhere with a bank. That's sort of the go-to for most folks. So is it possible that there are more efficient environments to store your wealth than in a bank savings account outside of the commercial banks that you don't even know about? And I would submit that most people, very much the answer to that question is yes. So when it comes to, we've looked at that, and these are really the framework that we like to use when we broadly think about wealth building. This is what we call our wealth pyramid. And at the bottom, you'll see the most foundational piece of it includes these three elements: financial education, financial awareness, and we must be better aware of our circumstances in the world around us. And then down here at the bottom, on the lower right part, is the saving strategy. And this is what we really call the infinite banking concept, which I refer to. And the vehicle that we use for the infinite banking concept is what I like to call the perfect asset. So these are at the bottom. And if your foundation, you think about a house or any sort of structure, it could be a marriage, it could be a family. If the foundation's not rock solid, when things go sideways, it can be a real problem. And so you start here at the bottom, and then you also look at on the top of this pyramid, what will eventually become a pyramid is a sort of really financial freedom. And you hear about it, people talk about it all the time, financial freedom and all this kind of good stuff. And how do you get to it? What does that mean? Part of the problem is that a lot of times people will think of that and they'll get ahead of themselves without having the foundational piece of the equation handled. I'll share a little bit of my story. My wife and I, back in 2007, we thought we were in pretty good shape. We owned our own home. We had a 6-unit rental property that was, fully rented out. My wife started an online business, and I was between the rental property and then trading in the markets. I was sort of dwelling in this area and learning a lot, doing pretty well for a while. But then when things went bad in 2008, because this part wasn't handled, this lower section here wasn't strong, we couldn't take it. And through a lot of ups and downs and questioning, and we eventually went through bankruptcy, personal bankruptcy, my wife and I did, in 2008. And it was tough. It was a really difficult time. So this is just an example of how we were sort of playing in this area a little bit like ahead of schedule, because this wasn't handled. So you see at the very bottom, we have the savings strategy. Then of course you get into, property and casualty insurance. If you own a home, and are these things optimized? Do you have the best, a lot of times that kind of stuff is automatic, your auto insurance, your home insurance, and you often don't really take a closer look at it to see if it's optimized. And then of course, debt strategy. Debt's a huge problem for a lot of people. And of course, life insurance, health insurance, disability, long-term care. Long-term care is something that not a lot of people really want to think about because it's so uncomfortable. Unfortunately, it's a real issue. I think the number is something like, I think it's up over 60% of people in the US who turn 65 will eventually have to get some sort of care, whether it's a nursing home, home health care, something whereby they have to be taken care of because they can't take care of themselves anymore. And it's woefully underutilized by people for a lot of reasons. So these are all just foundational pieces. Also living trust, making sure that things are in place so that when people pass away, it doesn't go to the courts. There's something called probate, I just went through it with my mother, and took about 2 years to get through the whole thing. And she didn't really have much in the way of assets. So there's all these things that really need to be put into place so that you have what we like to call tough money and you can handle adversity when it comes. On the top part of the pyramid is that's for once you get all this stuff in the bottom handled and in place, then you can start to get into this area up here where really having freedom in those 5 areas of life, traveling when you want to, all these things, cash flow management, investing if you want to get into investing. Investing is very much a personal thing. Some people love to get into, whether it's real estate or speculating in the crypto market, whatever that is. And I have clients who are in that sort of crypto space. And one thing that I've done is try to make sure this bottom part is being handled while their portion of their money is at work up in these speculative places. Because if it's not, if these things don't work out, all this stuff just keeps churning along and you have to deal with it. So that's sort of how we look at that. And another thing that if you think about it, with all these different areas, there's one common equation. There's one thing that has its hands in all this stuff, and that is banking. The banking equation. The banks, that's why in 2008 they bent over backwards to save the banks from failing, because they're so integral to everything, especially in the sort of Western, well, so we'll call it modern world. It can be a little different in some countries where it's not as much of a, but for the most of the world, banking is such a critical, almost like connective tissue for everything. Now, I mentioned before infinite banking concepts and how we view it as this foundational piece that's on the bottom right of the pyramid I showed before as a savings and liquidity, really foundational piece of the financial puzzle. The phrase infinite banking comes from this gentleman, Nelson Nash, who wrote this book back in 2000 called Becoming Your Own Banker. Highly recommend highly recommended reading if you haven't read it yet. And in this book, on the first page, well, page 3, but the first real page, this is really lays out what this is. Becoming Your Own Banker, the infinite banking concept, is the text for a 10-hour course of instruction about the power of dividend paying whole life insurance. So Nelson had been on the road teaching this seminar for the prior decade or so in the 90s, and decided to put his teachings into this book. And in many ways, it was initially designed to educate financial professionals so that they understood this and that they would then teach this to their clients. And the book is not about investments of any kind. It is a book about how one finances things in life, which can certainly include investments, but it's not about rates of return at all. So here's the problem. When you think about it, you finance everything in life. You either borrow money and pay interest on it, or you use your own money and give up interest that you could have earned. And the problem is that all of these items are financed by other banking organizations. So you think about people who like to pay in cash. That's all well and good, and I get that people don't want to go into debt. I understand that completely. The problem is you're still financing the things that you get, the things that you purchase. You're saving up cash, and then you pay for the item, and then the cash is gone. So you're doing this part, and you're giving up any ability for that money to grow. And what most people do is they do the other side where they borrow to get things, and then they pay interest out to outside banks. And again, lose the ability to earn interest on their own money. So this is an interesting little piece of the puzzle here. So think about this. What would you guess that the household income would need to be in the US in order to be in a top 1%, 5%, 10%, 25%, 50% of the US? It's probably similar in some other countries, but these are US numbers. And so just give a little thought to that. I know people tend to think of the Elon Musks of the world and Jeff Bezos. Well, those guys are more than 1% of the 1%. I'm just talking about 1%. So let's just take a look, kind of have in mind what you think those numbers might be. And if you're looking just to make 41,000, which is right around I think the median, the average income in the US. So put you in the top 50% in the US. How about 25th percentile, 83,682? And what would it take to be in the top 10% of the US in income earned? 145,135. And how about the top 5%? I'm sure a lot of you are thinking, geez, you got to be like uber rich to be in the top 5%. Not as much as you think. It's 208,000 plus to be in the top 5%. And then the 1% is, just over 500,000. Again, it's just to be in the top 1% in the US is not as much as perhaps you're thinking. Because you tend to think of, again, those other gentlemen and people I've mentioned before who are in the top 1%, another 1%. Now, what would you think worldwide you would need to be, on average, in the top 1% of income worldwide? Just think of a number. It's actually 34,000. So it's actually less than what it would take to be in the 50th percentile in the US. I think this is really valuable because I think a lot of us in the US, we can get caught up in all the noise out there. And I get things are tough. They can be a little crazy. We have the election coming up next week. But I think if you really look and see that the problem is that not that we're not making, in general, not making enough money, because statistically, we're the wealthiest country that's ever existed on this planet. And it's been that way for a while now. So what's the problem? What's if that's the case, then what's the issue? You would think that because we're so wealthy, why are we having all these issues? And I submit that it's because of savings. We don't typically save. There are times in our history where we have, certainly last century, 20th century, there were much higher savings rates. It was, I don't have the numbers in front of me, they're quite a bit higher than now. So the question is, how much should you be saving? This graph goes back to 2000, and it just shows you graphically where we are, where we've been, savings rates, 5%. You see here it pops up the over 10% occasionally. Not really sure what happened in 2013 to cause that. And then, of course, during COVID, probably just because people weren't traveling and weren't spending as much money, and they just stuck it in savings accounts. So they kind of jumped up quite high for a brief period of time, and then kind of came down a little bit of a spike here, and it's back to this sort of median of around 5%. And then the personal savings rate as of July was 2.9 in the US. So the common savings rate, if you look at that red line in the middle there, that's a sort of average over these last 20 plus years. What would be an uncommon rate? And that would be 10 to 30%. And those are some of the rates that you saw back in the last century, which interestingly, I would submit also is when running your money through whole life insurance contracts was much more common. So this is really another interesting thing to look at. This is put together looking at small businesses throughout the country and looking at how much cash they have on hand. They actually sampled 600,000 small businesses, multiple cities, and they measure something they called cash buffers, meaning how much cash do these small businesses have on hand to get through it? Like if money stopped flowing into them, and how long could they live? How long as a business, how long could they survive? How long could they make payroll and keep going and stay alive as a business? And you see, these are the best ones. So, out in the West Coast, 34 days, 30 days in San Francisco on average, which just means that these are, and we all know the numbers for the small businesses are a huge part of our economy. And if they're not saving, they don't have much in reserve, and they're really kind of living on a knife's edge. I can remember this myself. I had a small business years ago, just a one-man shop, and I had nothing in savings. I was going from project to project pretty much. So it's a real problem, even for the small business, not just individuals or families. So here's another question. This is another interesting thing to look at. Who has it? Who has this cash? So this is, you may have heard of Robert Kiyosaki. He wrote his first book, I believe, was called Rich Dad, Poor Dad. And it really had a big impact on me. I still had that old business of mine back in, this would have been the early 2000s that I read this book. And what really landed for me was this, and I got that, well, everyone applauded me for having this business that I started when I was a couple of years out of college. Really, I just had my own job. I was self-employed and had my own job. I owned my own job. I didn't really have a business. I didn't have a system. I didn't have people working for me. Partly I didn't want to because I had a small manufacturing business in the marine industry, and I didn't trust anyone else to do as good a job as me, which wasn't necessarily true, but that was my take on it. So after 16 years, I just burned out and I had nothing to show for it. So Kiyosaki talks about you want to get to where you're on this side, one way, shape, or the other, because there are just so many limitations or much less flexibility and opportunity if you just dwell on this left side. And again, as I mentioned before, the banker or the banking equation touches on all of these areas. This is another interesting thing to think about. So we talked a bit before about how most people think of savings and they think of sticking it in a savings account in a bank, most of which have a very paltry return, unless you get into high yield, which there are high yield savings accounts out there, no question about it. But one thing to think about is, where are these banks hoarding their cash? Where are they placing their money? And because these are examples of 4 very large publicly traded banks in the U.S.: Bank of America, Wells Fargo, Chase, and Citibank. And because they're publicly traded, they have to disclose where they keep their money, a portion of their money. And these are the amounts of cash they have in something called BOLI, and that is bank-owned life insurance. So it's interesting. So they do it, and technically what they do is they take lots of policies out on their employees. There are business types of life insurance that they can do. The banks fund them, they own them, and they keep all this money is sitting in cash in these life insurance policies. So you might think, interesting. They don't keep their money in their own system, in their own bank or in other banks or elsewhere. They keep them in these whole life insurance contracts. Why would they do that? Well, because they know the value of and the guarantees and all the benefits of having all this cash in these life insurance contracts. These guys aren't stupid. They really kind of run the world, for better or worse. So just one of those things that makes you go, So these are some common versus uncommon ideas and myths, really, about life insurance, whole life insurance in particular. So the common view is that they have a low rate of return, and they're really expensive to own, and it's the worst investment of all time. You have a lot of so-called financial gurus out there who talk about this all the time, and they'll buy term and invest the rest, which just means buy cheap term insurance, and just in case someone passes away, and then invest your money, the rest of your money in the markets somehow. And that life insurance, whole life insurance is a worse place to put your money. Here's the thing, and the misconception out there is life insurance, whole life insurance is not an investment. It has nothing to do with investing. You can invest with dollars that you put in there, but it's not in it of itself an investment. So there's a huge disconnect on that. If you're trying to compare whole life insurance to 401ks, they are different. They're different things. So that's a really important distinction to make. I like this. This is an old quote from Teddy Roosevelt. And again, this is, early 1900s. I mentioned before how that last century it was very common for people to have a lot of money going through their whole life insurance contracts. There were great stories of people like J.C. Penney being able to keep payroll going during the Depression with cash in his whole life insurance contracts. Walt Disney being able to fund his first theme park with cash out of his whole life insurance contracts when the banks told him that they were not going to lend him any more money. Ray Kroc of McDonald's fame, all kinds of people, especially last century. So I love this. Life insurance increases the stability of the business world. It raises its moral tone and puts a premium upon those habits of thrift and saving, which are so essential to the welfare of the people as a body. And I think that's so true. I found in my 10 years of working with these life insurance companies, these are mutual, what are called participating life insurance companies. Mutual meaning that they're not publicly traded. They don't have a share price. They don't have quarterly calls. They're not concerned about a stock price. It's not even part of their world. They operate differently. And most of the ones we work with have been around for at least 100, 150 plus years. So they have a long track record. And excuse me, they're extraordinarily conservative in their approach to how they grow, because you think about it, they have these death benefits that they're responsible for at some point. And they have to grow their business to satisfy these at some point. And they also have to have a lot more in reserve than, for example, banks do. So I just like this term because it's sort of, they're very responsible. There's nothing wrong with being responsible. You can still have fun and be responsible, but I've just like to share that as my own experience with these companies. Now, an uncommon, what people don't know about these whole life insurance contracts, especially these ones with the mutual companies that I just mentioned, they have these guarantees. Obviously, the death benefit, people are familiar with that, and they tend to think of life insurance as your loved ones will get a big chunk of money tax-free at some point, but it doesn't really do any good for you. Well, that's not accurate. They have guaranteed growth inside what's called the cash value increase. Another reason why these banks, like I showed a few slides back, like to have so much money parked in these whole life insurance contracts. And the premiums never go up. They're level. They stay constant throughout. And then these are some of the different sort of like spokes of the wheel that are the benefit of these contracts and why they're so valuable and why the banks love them so much. So you have, I'm not sure, let me get this out of the way a little bit more. The constant compounding, liquidity, privacy, income tax-free, transfer wealth, competitive yield, monthly cash flow growth, and the flexible loan provision. I'll go through each one individually. So I just mentioned this with the guarantees. The excuse me, the cash value, the cash surrender value was actually created by these back in the 1880s by these whole life insurance companies as to encourage policy owners to keep their policies in place and keep paying premiums, keep them going, rather than let them lapse and go away. And they said, okay, what if we'll take your premiums and we'll also have this separate account called this guaranteed cash surrender value that, yes, you can surrender the policy and get the cash if you decide to surrender the policy and let it go, but more importantly, you can access that cash ongoingly. And that way it's almost like a hybrid of a line of credit that you fund and it grows and you can access the whole time. And they originally, and they still do. They are designed to equal the death benefit at a future age. So they actually are they're guaranteed to grow and equal the death benefit at some future year. And they do something that's called they endow. They have an endpoint. It used to be when the insured person turned 100 years old. Recently, they changed it to 121 because people are living longer. So you will see someone will have a whole life insurance contract and live really long. People are living longer. And at some point, they'll reach age 121, and the life insurance company will say, hey, this contract is endowed. We're going to cut you a check for whatever is the cash surrender value is. And then we part as friends, and the contract is null and void at that point. So that's the guarantee part of it, the constant compounding. So on the top here, this is sort of the saver. We talked before about someone who likes to save up their money, pay cash for it, and then get the thing they need, whether it's a car or whatever it happens to be, and they go back to zero. And then on the other side is the borrower, someone who doesn't save up. They just borrow. They need a car and they figure out, okay, I can afford $300 a month. I'll get the car and I'll take a loan out and then pay it back. And you see both sides are working back to zero. And the banks love both these folks because they're sort of the middleman in between, especially on the bottom part here. And then, oops, sorry, I got ahead of myself. Let me go back by one. Sorry. Okay, so, and then here is the wealth creator. This is where you want to get to, where you're incorporating your policies, it's growing. That's represented by this green line here, the guaranteed cash surrender value, and you tap into that money for whatever you need. It could be vehicles. Both the vehicles that my wife and I own were paid for out of cash value in our life insurance policies, and then we replenish them, and then we use them again, replenish it, use it again. The whole time it's growing, compounding. These contracts they're long-term nature. It's good to think of them as a long-term wealth strategy with short-term ability to access your cash. They serve both. Over time, the compounding effect is pretty extraordinary. And again, because of the nature of how they're set up, the money inside your cash value is tax-free and accessible tax-free, as long as you do it correctly. Liquidity. These are fully liquid and available to you. This is how you access the cash in your cash value of your whole life insurance contract. It's a guaranteed line of credit. You don't actually pull the cash out. So, which is another important piece of the puzzle. So inside your cash value, when you access it, you take a loan out from the life insurance company, collateralized by what's in your cash value, just based on what's in your cash value, what's available. So the company lends you the money and you do what you want with it. And then they have an unstructured loan. And you might not have ever heard of that term before because for the most part, people don't know they exist because in the real world, not the real world, but in the banking world, that doesn't exist. When you take a loan out, they put you on a payment plan. You have to pay some amortization schedule, some amount of money that you have to pay every month, and there's some minimum amount you have to pay. And if you miss a payment, there's a $30-$40 late fee. And if you go delinquent, then they get the thing back, say it's a car or whatever that might be. These unstructured loans with these life insurance contracts are completely different. They charge a simple interest rate. You actually don't ever have to pay them back. It's best if you do. And I coach all my clients to do that because you want to act as an honest banker for yourself. But there's a lot, because it's unstructured, you have complete control of how you do that. If you take loans out and you have a rough patch and you can't pay the loans back, that's fine. The company's never gonna, bang down your door. They'll just let you know. And even if you have loans outstanding, the simple interest that accrues, as long as you, on an annual basis, when your policy starts, what they call the policy date, and pay the interest back on what you've borrowed, that money goes right back into your cash value. You don't lose it. So it's almost like it's unique in that regard, and that interest that's accrued from your loan, as long as you pay back the interest on it, you don't actually lose that money. So it's extraordinary. And privacy, these are private contracts with a life insurance company. So unlike 401ks and the like that are government programs, these are much different. And I have clients who have policies on their young children with the idea of them being for a number of things. They have lots of things. It could be, but also for college funding. And for example, if you have policies on children and you get to where it's time to go to school and it might be helpful to take out some student loans, the student loan, whoever it's the feds or whoever you're trying to get money for education from, they cannot look inside your cash value of your whole life insurance contracts. They're not privy to that information, which is just another nice thing. So the privacy is another big piece of the puzzle. And then inside of here is the monthly cash flow growth. And with our, sort of preferred carrier, OneAmerica, you can see that how that money grows inside your cash value on a monthly basis. And then this is the one where a lot of people are more, the income tax-free transfer of wealth when the death benefit gets paid. This is an interesting. It's funny, as infinite banking, we tend not to focus on the death benefit so much, but it's an important piece of the puzzle. It's hugely important. It's partly why the IRS lets, when you structure it the right way, that why they allow that internal growth to be tax-free and accessible tax-free. So it's a hugely important part of piece of the puzzle. This is interesting. If you look at the death benefit claims of unpaid death claims, so these are these are life insurance policies that are out there, and the uninsured people are still alive. So there's just at some point they're going to have to pay that out, and it's really pretty close to what the national debt is, which I think is interesting. And again, I go back to this Teddy Roosevelt. There's another quote from I'm a musician, and there's a pretty well-known American composer. I think his name is, I'm not sure if it's Ives. It might be Ives, who was in insurance. And he had this great quote about just how important life insurance is on so many different fronts. And I have to find it. I'll have to incorporate that at some point. But just in the meantime, it's usually important, I think. And then the competitive yield. The consistent and predictable net growth inside your whole life contract. It's guaranteed. And beyond the guarantees, these are, because they're dividend paying life insurance policy, insurance companies, what that means is when they earn a dividend, that means they've done a good job and they're profitable. They then share the profits with the policy owners in the form of dividends. And the way we set them up is we have the dividends buy more life insurance, which keeps it tax-free and helps the whole thing grow. So over time, and this ties into the compounding part, which I mentioned earlier. So as I mentioned, OneAmerica is one of there are probably a dozen of these mutual life insurance companies, some better than others, a handful that I like, and OneAmerica is right at the top of the list, largely because they have really the strongest guarantees of all these companies, which is usually important. Real quickly, we have about 15 minutes left. I just want to touch, these are some actual examples of policies. Let me just get this thing out of the way. Here we go. Up here. Okay. These are real policies of one of my partners at Factum. And all of these are less than 6 years old. This was started on a child. And this represents the total annual premium. The minimum just means it's kind of the same thing as the base, what they call the base premium, which is kind of pays for the death benefit, and down the road really benefits and it kind of contributes to the growth and the compounding of these contracts. So this is the total premium, total cash value right now, and in this case, 131 new dollars are growing inside the cash value, and that's the total death benefit. So this is for future financial needs. So this is Someone who was set up as a small child. Unfortunately, I didn't know about infinite banking until about 10 years ago. My kids are already grown, but we have policies on each one of my 20 somethings that we fund and control and we utilize. And at some point, probably in the next 5 years, once they're a little bit more, have their legs under their feet financially, we can hand ownership to them and they can do what they want with them. And they'll have a nice, you know, chunk of money in here that tax free that they can tap into, and I'll teach them how to use it properly. So, and just bear in mind too, because in this case, the parents being the owners can use this money all along the way. My wife and I have done that with our policies on our kids, and they're part of our system. And then the next example, what happened to my? Hang on a second. In this next example of the savings and liquidity, this is sort of the goal of this next person. And this is a 25-year-old, recently out of college, making some money and just loves the idea of having just a better place to store his savings and liquidity rather than sitting in a bank. And $4,000 a year total premium. This is the total cash value in there now, and this is the monthly growth inside of it and the death benefit. And then this next one would be a savings liquidity. Another example with someone just a little bit older, a little more along the way in his profession, a little bit of a higher premium amount. Again, the total $26.56. It's important to just a little sidelight here for these. Even though that you think of whole life insurance as some people tend to think of it, the premiums as being pretty strict. And there's really quite a bit of flexibility. So in all these cases, as long as on an annual basis, this part here, this base premium is handled, and you can you can do it monthly, you can do it quarterly, biannual. As long as that's handled, you're good, and these policies will keep going, and you have the flexibility to add in this extra premium anytime you want during the year. And in some cases, you have even a couple of years to add in that extra money. So they're quite flexible, much more than people think. So in this case, it's $480 of new monthly cash flow coming into this in this example. And we'll go to the next then. This is a couple of this completely different person, 66-year-old woman. In her case, her motivation was when she was younger, her family had a farm. And this, I believe out in Arizona, and some land, and her father had passed away. And he was the final, I guess the mother had passed away before. And upon the father's passing, it went into probate. And he didn't have a plan in place to handle the expense of the estate taxes on the land and on the farm. So this woman, as a younger person, they lost their beloved property because they couldn't afford to pay the estate taxes. So she, years later, she's doing quite well and has, her own rental properties, and she doesn't want that to happen again. So her motivation is to put money into this policy and have it so that when her time comes, there's plenty of money for her heirs so they don't lose it. They can pay the estate taxes and they can continue that sort of intergenerational wealth, as I like to call it. In this case, this is someone quite a bit different. This is more of an investor, 36-year-old, has some rental properties, I believe, and a higher. I have some clients myself who are pretty similar, about a little bit older, about that amount of premium, have a good job, and have some investment properties. And so this is how it looks in this case. Much bigger death benefit, and this is the monthly tax-free growth inside of this person's policy. And then this is, a much different situation where you have a business owner, still a pretty young guy, very successful, and just loves the idea of having his money in a better place to run it through for all his business opportunities, and also to, for as protection for kids and his wife. And also he experienced being sort of snubbed by the bank. So he loves the idea of being his own banker and being able to act as a banker for other business owners who may have trouble getting money from the banks. So that's really his motivation. You can see in this case, 17,000 plus of cash value monthly growth inside of this thing. Again, all tax free. So again, this is just an overall picture of the guarantees, the compounding, liquidity, the privacy, the income tax-free transfer of wealth, the competitive yield, the monthly cash flow growth, and the flexible loan provision. That all. So we touched a bit before on the different stages of whole life insurance. And at the bottom, this foundational part is with a saver. And a lot of time people who come into infinite banking, they'll just start here. Most of my clients are, and myself, we sort of start here where we get the education, the awareness and understanding. And again, I didn't know about this until about 10 years ago. So, and then the second level is where you're a little further up that pyramid and you start to do a debt strategy. I have quite a bit of clients who are in this stage where they get this part handled, the blue part, and get into a debt strategy, and then you keep going up, and you learn more, and you experience more, and you put it to work, and you get into like where you're a business banker, and you can start to enjoy this higher up part piece of the puzzle because all these foundational pieces are in place. And then the ultimate is get to the fourth level where you are an infinite banker. Again, savers, we'll move IBC right down here at the bottom right as a foundational piece of the puzzle. And you get that. This is kind of where most of my, quite a few of my clients are. They're either in the blue area or the green area. And when I say debt strategy, where you start to not just pay off your debt, but actually turn it into wealth by incorporating and redirecting cash flow that's going away from you and bringing it back into your own system. And then as you go along and you get things handled and you're running more of your money through your own system, and you can start to expand your banking system. This is for my wife and I. Sort of, I see us being in this sort of area in the coming few years, and ultimately getting it to where you're family banking, you're getting other people involved. I have partners who do have large families, and a good portion of the families are involved in their family bank. They're running everything through as much as they can through their system. Car purchases across the family, creating multi-generational legacy and wealth preservation. Nelson in his book talks about thinking 7 generations ahead. I think it's 7, but it's really a long-term kind of a thing where you sell this generation, get the next generation on board, understanding how this works, so it stays with you, and continues to. It's kind of like you think about the Rockefellers and the Kennedys. They sort of did that in a way, in a different way, but you can sort of do the same thing, but for your own family. Again, the difference here, investing, intentionally separating your control of money with the expectation that additional money returns in the future, versus banking, intentionally keeping your flow of money permanently in an environment where you have complete control and accessibility. They're two very different things. The difference is you can do this and this. You can't necessarily do this and this. Think about that. So become more. New education, become a new you, and you become aware of the options that are out there. You can do nothing, or you can start to implement and take this education, understand how things really are, and understand, with a coming from a place of grace that, the banks and the government and institutions, they don't necessarily have your best interest in mind. And I'm not talking about the individuals who work in banks or work in the government. I'm talking about them as entities, as institutions. They tend to kind of build this sort of momentum and inertia where their main driver is to keep the entities going or keep the institutions going. And it's kind of our job to not just get swallowed up into that, because they don't necessarily have our best interest in mind. It doesn't make them bad, It's important to understand that, and that the more education, the better. And that's really about it. These are, I have lots of. I'll drop my stop share here. Actually, no, I was going to say, I'll stop share. I'll come back into here, and I'm just going to drop my Calendly link into the chat. And please feel free to book a call and let's have a conversation. If you're so inclined, this stuff is really, it's really important to me that people understand how this works and that this is an option for them. We have a
can
tremendous
ask
amount
you
of
a question,
resources.
can I?
I'm really excited with my partnership with Factom Financial that I have even more resources available to me and the people I'm working with. So, excuse me. Thank you so much.
Bless you.
Hope you enjoyed it, Margaret. Thanks for being here and hanging in there. I appreciate
And
it.
anyway,
Feel free to
can you
pop
hear
in a
me?
question if you have anything. Otherwise, I'm going to check off. I'll be sending the recording out tomorrow sometime for those of you who couldn't attend. Happy Halloween for those of you who celebrate. Enjoy, and we'll take care and be well. Bye.
Okay, bye.